Will Lotus Resources provide investors with life-changing returns if they were to invest right now? Let's dive into exactly what this company is all about. They're not making any money right now. Negative earnings per share, market cap of $522 million. So what is this company about? Well, in a nutshell, they have two strategic uranium projects clearly not in production yet. One is in Malawi, one is in Botswana. The Malawi one, existing plant and infrastructure in good condition, proven production with 11 million pounds over 5 years between 2009 and 2014 before shutdown due to low uranium price. Then the one in Botswana, globally significant uranium resources, 190 million pounds of uranium ready for development. That's like $20 billion worth of uranium in the ground at around $100 per pound spot price. So this company has exposure to massive amounts of uranium. And remember how in my Paladin video last week, I showed how Paladin, if combined with fission, would be the third largest uranium mine in the world. Well, look at where Lotus is. Paladin is saying 162 million pounds attributable. Obviously, the company is saying they have more resources than Paladin was saying in their presentation, but still, it's a top 10 asset. And then we have Malawi, right? Because some people are afraid of investing in Africa, but what they're saying is Malawi is the warm heart of Africa. Rio Tinto recently invested $40 million in a sovereign metals project, one of the largest globally. Foreign policy is considered pro-Western. So what they're saying is the jurisdiction is safe, but it's definitely something to always consider. And then Botswana is apparently a top mining jurisdiction in Africa. Overall global ranking of 2 and top 3 ranking in Africa consistently over the last 5 years. Mining accounts for 21% of current GDP and is critical for continued economic growth. Very interesting. Not exactly a A+ jurisdiction. The company is very comfortable with it at this point. Challenges: competing with high-paying diamond industry, first uranium mine, and landlocked. And there's absolutely nothing showing that this mine cannot get their uranium out of the ground. So that's positive, right? There are a few small challenges, a few risks associated with the jurisdiction, nothing crazy. Again, nothing on the horizon indicating that they won't be able to get their uranium out of the ground. So these are the real numbers, right? This is what, according to them, in Paladin's chart, they should be the 7th largest asset in the world before Bannerman, right? Because what they're saying is they have combined resources of 241 million pounds, right? That is just tens of billions of dollars worth of uranium. In blue, we see the Botswana mine, and in green, we see the Malawi mine. So the Malawi mine is expected to go in production first. They're saying initial capex of $88 million to get it up and running. So we have to look at the financials to understand if that makes sense. Robust mine life of 10 years, producing 19 million pounds of uranium, 2 million pounds per year. So in this chart, blue is the Malawi mine. They're expected to just pump out millions of pounds of uranium per year. And then in green, we see when the big mine is expected to come on. So this is a powerhouse asset. If they can get it up and running, just expect major cash flow and profits for this company. Now let's look at the value proposition, right? The enterprise value in dollars per pound. This speaks to how undervalued assets are. This is very interesting, right? Because what they're saying is they are, after Bannerman Energy, they are the highest value proposition on the planet, meaning the value of the company per pound of uranium that they have is 2.6. Bannerman's is 2.5. Deep Yellow, 3.1. Aura Energy, 3.5. Peninsula, 3.8. Paladin, 9.7. And then Boss Energy, 29. Now, Paladin and Boss are massive assets, right? So they can do a lot more financial engineering to grow, to acquire more assets. So the market is favorable to these assets, right? Because the bigger you are, the more scale you have. And so I covered Boss and Paladin in separate videos, but Lotus, Bannerman, deep value. To buy this company, you're paying $2 or $3 per pound of uranium in the ground. And we know each pound of uranium is worth something like $85 per pound. Obviously, it costs money to get out of the ground. This is the Malawi mine, which is expected to come online in the future. It's low cost, right? So they're saying at a spot price of $106 per pound, their cost is $38. That is like nothing. And that makes this mine a massive cash cow, right? Look at the margin. So you're going to pay $2 per pound to buy this asset, and you're in theory going to get $68 per pound in profit. So for your $2 investment, you're supposed to be getting $68 per pound in profit. Massive value proposition for this asset. Okay, so that's the bull case for these assets. What about the financials? What about the future? How does it all look? Well, they're not making any money in the last 12 months. They've lost about $24 million, right, in Australian dollars. They've lost $24 million. I'm not saying lost. They've invested $24 million. Let's look at their balance sheet. How capitalized are they, right? They have total assets of 169 million Australian dollars. They have total liabilities of 41. So they're totally solvent, plenty of capital. Let's look at their current assets. They have $35 million of current assets. They're spending about $24 million per year. But if you back out their current liabilities, they have like $3 million of current liabilities. So they have current net assets. These are the assets they could liquidate within a year to pay for whatever they need to pay for. As of June 30, 2024, of like 32 million. They're spending 24 million a year, right? So they have enough to get through the next year. They're in a healthy financial position. The question is, what comes next, right? Are they at risk of dilution? They very well may be. Let's look at a research report from Red Cloud. So on September 4, 2024, Lotus secured a $15 million loan facility for restart of its 85% owned Malawi mine. The loan covers 17% of the initial $88 million CapEx. That's to get the Malawi mine up and running, right? Which is supposed to be kicking off 2 million pounds per year. Not a bad deal at all, right? Because they're saying this mine is going to cost like $30 per pound. They're going to sell it at 80. So they're going to be getting $50 per pound of uranium. So if the profit per pound of uranium is $50, and they're doing 2 million pounds per year, that's literally $100 million of profit per year. And it's only going to cost $88 million to get it out of the ground. This is a massive, massive powerhouse company from that perspective. And they're saying they do have a 10-year production window for that mine. So extremely profitable. And this $88 million CapEx seems like a great deal, even if they were to dilute their shareholders to get it. They don't have enough to cover the CapEx. They're probably going to dilute their shareholders a little bit. By dilute, I mean issue equity, dump it on the market. But it's not the end of the world because they're supposed to be extremely profitable in the future. They're also selling future uranium. So they've secured a non-binding agreement with Public Service Enterprise Group for the supply of 800,000 pounds of uranium from 2026 to 2029, a binding agreement with Curzon Uranium for the supply of 700,000 pounds of uranium during the same period. The agreement is conditional upon making a sale and purchase agreement within 4 months and proceeding with the Malawi mine restart. The Curzon agreement requires an equity raise in conjunction with the restart of the Malawi mine. So shareholders want an equity raise. They're probably going to get an equity raise, right? But the offtake pricing is based on current long-term price of $80 per pound, which provides a healthy margin against the estimated $36 per pound for the first 7 years of production. So these are the projections, right? When does all this kick off? Well, in 2025, nothing expected. In 2026, they're expected to finally produce 1.8 million pounds, and they're expected to earn about 4 cents per share, right? So 2026 is going to be the big year for this company. And if it can just execute on its strategy, it should do extremely, extremely well. Red Cloud is giving a price target to this company of 70. Currently, the price is 28 per share. Right. And that makes sense. To me, that's totally fair. If the spot price of uranium, which is in a multi-decade supply crunch, starts to go up, then this asset could easily provide those life-changing returns. It could be a 10, 20x, but it's based on a skyrocketing uranium price. Now, even if that doesn't happen, the economics are fine. They're going to do an equity raise. If that can get them into production, they're going to be profiting massively. So yes, in a uranium bull run, this thing can absolutely skyrocket because the fundamentals are strong and the future is bright. And as the spot price goes up, this thing will absolutely skyrocket. Like we've seen uranium mines skyrocket previously. Look at the chart of Paladin in the last uranium bull market. And obviously we're just getting started on a uranium bull market. In the last uranium bull market, Paladin went from $1 to $75. Look at where it is now. Lotus is in a similar position to take advantage of the coming nuclear renaissance.